SwayamPrabha. Digital India. Educated India.
Hello everyone, welcome to today's lecture on global real estate investment and overview as part of the course Real Estate Finance and Investment Strategies. First, we'll talk about the learning objectives of this particular class. Understand the fundamentals of global real estate investment, then identify key international real estate markets and their characteristics, analyze currency risk and its impact on cross-border investments, evaluate legal, regulatory and tax consideration in international markets, and then recognize cross-border challenges and mitigation strategies, and apply global investment strategies for portfolio construction. Now, first, what is global real estate investment? So, fundamentally, it's about acquiring, developing, managing, and eventually disposing of property assets outside your home country. So it sounds simple, but the implications are profound. For Indian investors, this means accessing mature, transparent markets like the United States and United Kingdom, while also tapping into high growth emerging economies beyond our domestic opportunities. Think about it. While you might be familiar with investing in Mumbai or Bangalore, global investment opened doors to Manhattan office buildings, London logistic facilities, or Singapore prime commercial properties. The key components here are the geographical diversification across international markets, currency exposure, cross-border compliance, and international operation management. Now, each of these components bring both opportunities and challenges that we'll explore in detail. So, if you are sitting in your home country and you want to invest in other parts of the world, that will be your global real estate investment, and your idea can be that we have discussed earlier in the previous lectures that when we go for portfolio of real estate and we try to diversify our investments, one of the ways in which we can do is that geographical diversification we can do. So this is something which we are trying to do, that instead of focusing only on maybe India, we can go outside and invest in other parts of the world, and that way one specific type of diversification which we can achieve in this also, that we can go outside the country. Portfolio will have properties from around the world. Then the scale of global real estate investment. So total global real estate investment value, which is around 320 to 340 trillion. Now, this is just an estimate. So, to put this in perspective, that's roughly 4 times the global GDP, right? So, of this massive pie, approximately 10 to 12 trillion represent investment grade real estate, properties suitable for institutional and sophisticated investors. The annual transaction volume ranges from USD 800 billion to 1.2 trillion. And here's what particularly interesting for us: around 20 to 30% of all commercial transactions are cross border. So this means international investment isn't a niche activity, it's a substantial part of the global real estate ecosystem. From an Indian perspective, outbound investment in 2022 was $2.3 billion, primarily flowing to the destinations like UAE, UK, US and Singapore and Australia. So the primary players are institutions, high net worth individuals and non-resident Indians. So this represents tremendous growth potential as Indian capital seeks global diversification. Then why one would like to invest globally? One is that we have understood is portfolio diversification. So we can reduce our geographical risk. We have looked at geographical risk reduction through India, that we can diversify in different parts of the country, and then because there is difference in the market, and even at the micro market level the differences can be there. So of course differences will be there in the city or regional levels, but of course there are certain factors which impact all the places in a country's geographical limit. So for example, if we are talking about the GDP or the macro impact, macroeconomic indicators impact on the real estate, so that will be a broader impact, not just on a specific region. So that way, like we have discussed in last class, that macro do impact real estate a lot, and at that time all the properties in a particular country will be affected. And if we talk about India, so India will also, all the regions will be impacted at certain levels. So if we want to really diversify in geography terms, a very good option can be that we can go outside India and also invest. So a broader real estate portfolio which comprises of properties across the world. So exposure to different economic cycles, they will be having a different economic cycle from us. Reduce correlation with domestic market performance. It's not necessary that the kind of economic factors which are impacting India at a particular point will impact other parts of the world also. And protection against country specific risk. We understand that there can be certain factors which might impact only a specific country at a particular moment of time. So that way you can have a good diversification. So example for Indian investors, we have domestic exposure, Mangaluru, Mumbai office. We have global diversification. We have European logistics plus US multifamily real estate, and the result will be the protection against Indian office sector downturn. Statistical benefit would be markets don't move in perfect synchronization because there is a complete disconnection between these markets, and when one market declines, other may remain stable or grow. So that kind of advantage one can get in a portfolio setting. Then we talk about the second reason, that is enhanced returns. So we have yield opportunities which are available because of this action. So we can have access to higher yielding markets, right? Then we have market inefficiency arbitrage, that also we can look for. So that way, and we can also have strategic cyclic timing. So these are some reasons. So you also gain access to specialized sectors that might not be available domestically. So you have data centers in Northern Virginia, student housing in UK, or logistic facilities serving e-commerce in Germany. So these type of opportunities are available to you. And for yield, you can expect a 200 to 400 basis point enhancement, right? So substantial, it will be substantial when you are deploying significant capital. And so there are like for example, in Mumbai, prime commercial properties typically yield 7 to 8%, while Eastern European commercial properties can yield 10 to 12%. But it's not just about current yields. Global investment provides growth access to emerging markets with superior growth trajectory. So if somebody is looking from outside, they might say that, okay, let's go to emerging markets and invest there. So they may, increase. So this way, this can be a very good way to look at these opportunities also, where you are enhancing your return by going global. And there's a mix. You can have a mix of emerging markets with superior growth trajectories, developed markets with, stable appreciation. So depending on how you have your strategy clearly planned for real estate, you can decide on this. So all these are some, important factors which, play a role in enhancing the returns. And that is why somebody might look for global investment. Then why invest globally? The third reason would be currency benefits. So we have hard currency denominations, USD, we have British pound, and we have euro. So there is, there is a difference between the different currencies. We can have a diversification in that. So basically, for Indian investor, this has been, particularly significant over the past 2 decades, because if you see the historical currency trends from 2000 to 23, you can see that Indian rupee has depreciated approximately 93% against US dollar, 49% against the British pound, and 144% against the Singapore dollar. So these aren't small movements. They are, structural shifts that have massive implication to wealth preservation. So the practical impact, if you want to see this example, so if you had invested in London property, you would have benefited from both property appreciation and currency appreciation when converting returns back to Indian rupees. So this creates a natural hedge against INR depreciation and provides wealth preservation through geographical distribution. And then we have hard currency denomination in USD, GBP or Euro. Isn't just basically about returns, it's also about protecting purchasing power over the longer term. So now look at the key global markets. So for example, United States. So the world's largest and most liquid real estate market with a total value of USD 50 to 55 trillion dollar. It's ranked number 1 globally for transparency according to JLL index. Then we have key markets like New York, Los Angeles, San Francisco, Chicago and Boston offer different opportunities. You might invest in multifamily properties, stable rental apartment buildings, industrial facilities driven by e-commerce growth, and then traditional office properties in central business districts, or specialty sectors like data centers and life science facilities. So these are the areas where you can look for investing in US. So for Indian investors, US office offers strong legal protection and currency hedge potential. However, be prepared for high transaction costs in gateway markets. So the regulatory framework is well established, making it relatively straightforward for foreign investors to participate, though tax consideration can be complex. Then we go to another market, which is United Kingdom. So you are talking about size of USD 10 to 11 trillion in total real estate value, offers a unique advantage for Indian investors. You have English language and common law systems provide familiarity that shouldn't be underestimated, because the legal concepts, contract structure and business practices are more intuitive for Indian investors here. And then London remains the primary gateway, but Manchester and Birmingham they also offer compelling opportunities. And then they can also, because of their growing nature, can provide better yield. The market basically features historical connections and cultural familiarity that ease the investment process. So overall, much more similarity you will find with United Kingdom in comparison to United States. However, be aware of Brexit implications and foreign buyer SDLT surcharges. Such charges will be there. The UK has implemented additional stamp duty charges for foreign buyers, which affects your acquisition cost. Popular sector include office, residential, retail, logistics, and the growing student housing sector. So these are some emerging sectors in this particular market. Then we go to key global market, which will be Singapore. So Singapore represents the gateway to Asia with the top 10 global transparency rankings and excellent governance. Its strategic location and political stability make it particularly attractive for Indian investors seeking Asian exposure beyond domestic markets. And then large Indian diaspora and geographical proximity provides operational advantages. Then we have additional buyers, stamp duty up to 60% for foreign buyers, and there are foreign ownership restrictions to consider. So popular sector would include prime office, luxury, residential, industrial, and hospitality. So another factor, the Singapore's dollar stability adds another layer of currency diversification for Indian portfolio. So another important market for Indian investment can be Singapore. Then another key destination would be UAE. So Dubai presents a unique value proposition. There is no property tax, income tax, or capital gain tax for Indian investors. This tax efficiency is compelling, especially when combined with the foreign freehold ownership in designated zones. So 3.5 million Indian expats and geographical proximity creates natural operational synergies. Then we also have AEDs which is pegged to the UAE. So AED, which is UAE's currency, so it provides currency stability, and there are no foreign ownership restrictions in the designated area, so that also helps. So but however, you have to consider high price volatility historically and less market transparency compared to developed markets. The regulatory environment continues to evolve, generally in favor of foreign investments, but due diligence remains critical. Then we move to understanding the currency risk. So now let's go into that. Arguably, the most critical concept for global real estate investors, currency risk is the potential for exchange rate movements to affect the investment returns when measured in your home currency. So there are three types of currency risk you can understand. So we have transaction risk, which occurs between agreement and settlement. So exchange rates can move during the closing process. You have income risk that affects the home currency value of your foreign rental income. So your UK property might generate steady pound income, but if the pound weakens against the rupee, your INR return suffers. And capital value risk basically impacts property value at disposition. The building might especially appreciate in local currency, so but it will lose value in INR terms due to currency movement. So basically all these factors are working there. So here's the critical point: currency effects can significantly enhance or diminish returns, and sometimes more than the underlying property performance. So this is the key point here, that even though your property may perform well, you are getting good returns for your property, but if there is the currency depreciation, for example, there is US currency getting depreciated, or UAE or UK or any other part of the world where you have invested, in comparison to Indian rupee, you will see that you will lose, even though you are performing well in the property investment. So currency risk is very important factor to be considered in such type of investments. Then we go to currency risk, practical example. So you invest 10 million and in a London office building, and when the exchange rate is 100 per pound, that's 100 crore investment. The property performs well, generating at 8.2% IRR in GBP and selling for 15 million pounds after 5 years. So, but here's when the currency impact becomes dramatic. If the pound appreciates to 110 per pound, your INR jumps to 11.5%, and if the pound remains stable at 100, your INR IRR stays at 8.2%. But if the pound depreciates to 90 per pound, your INR IRR just drops to 4.8%. So the key insight: some property performance dramatically, create different investor return. This is why this currency risk management isn't optional. It's essential for global real estate investment success. Then we go to currency hedging strategies. So given currency's risk importance, let's explore the hedging strategy. So we have financial hedging, involves forward contract to lock in future exchange rates, currency options, providing rights without obligation, and currency swaps for exchanging cash flow. And then we have natural hedging, which is can be even more effective. Borrowing in the property's local currency creates a natural offset, matching the income and expenses in the same currency, and geographical diversification across multiple currencies. And then a recommended approach would be a partial hedging approach, where hedge 100% of income for first 2 years when cash flows are more predictable, 50% of income for 3 to 5 years as market condition evolve, and 25 to 50% of the expected capital return depending on your risk tolerance. So this approach balances hedging cost with the risk protection while maintaining the upside potential. So this kind of partial hedging approach can also be very beneficial in such scenarios. Then we go to the legal system and property rights. So legal system familiarity significantly impacts investment complexity and risk. Common law systems in the US, UK, Australia and Singapore are familiar to Indian investors, offer strong property rights and their protection, and provides greater contract familiarity and flexibility. So civil law systems in Germany, France and Japan involve more statutory regulations and prescribed formalities. Mixed systems in UAE and Malaysia combines different legal traditions and may include religious law influence. The investment implication is basically clear. Legal system familiarity affect transaction complexity, cost and risk assessment. When you understand the legal framework, you can move more confidently and efficiently. So understanding the legal system and property rights is important. You will find commonality with US, UK, Australia, Singapore. So because of the language also, you may be able to better understand their laws. You will also see that, you know, some laws in Germany, France and Japan you might not you know, they see as it is, but you will, you know, understand, you can understand them by, you know, reading and going through the regulations more keenly. And also in UAE and Malaysia, where you know, religious law may also influence the property law. So that kind of you know, awareness of legal system can be very useful in such type of investments. Then we go to foreign ownership restrictions. So foreign ownership restrictions vary significantly by country and can dramatically impact your investment strategy. Complete prohibition is rare for commercial properties, but many countries implement designated area restrictions, like the UAE, permitting foreign ownership only in specific zones. Approval requirements exist in countries like Australia, which requires FIRB approval for most foreign purchases, and additional taxation is increasingly common. So Singapore's ABSD up to 60% for foreign buyers, or Canada's foreign buyer taxes of 15 to 20% in some provinces. And so Indian investor strategy would be to often, you know, focus on commercial rather than residential properties in restricted markets, as commercial properties typically face fewer restriction and offer better investment fundamentals. Then tax complexity in global real estate investment involves multiple layers. So acquisition tax, like in UK, SDLT up to 15% for foreign buyers, or Germany's transfer tax of 3.5 to 6.5% affect your entry cost. Then ownership taxes such as US property tax of 0.5 to 2.5% annually impact ongoing returns. Then income tax on the retail income and withholding tax on foreign investors affect the cash flow. And then capital gain taxes like US FIR PTA, that withholding or UK's 20 to 28% non-resident CGT impact. So these exceed these impact the exit proceeds. And so don't forget estate and inheritance taxes that may apply regardless of your domicile, and each layer requires careful consideration in your investment analysis and structural planning. So all this basically, how well you understand tax rules of a particular country is very important. Also, that is, by the time you have made investment and by the time you are exiting, there can be, you know, difference in rules, especially the exit rules, you know, that you will have to be very clear about. Maybe sometimes what we do is that when we are buying, we are looking about all the buying formalities and everything, but maybe not focus that much on the exit strategies. So you should be clear that when you exit, what type of taxes you will have to pay and how much you basically will lose on all that, so that you can understand that what and how much you can take out in this investment. So these are some tax consideration you have to look into. Then double taxation and tax treaties. So where the same income is taxed in both the property country and the home country, for example in India, is a major concern. Fortunately, India has a double taxation avoidance agreement with over 85 countries. So key DTA benefits include tax credits offsetting foreign taxes against Indian liability, reduce withholding rates or rental income, and capital gain treatment, avoiding double taxation on property sales. So for example, UK property rental income taxed at 20% in the UK can be credited against Indian tax liability, avoiding double taxation. Understanding and properly utilizing these treaties is crucial for tax efficient global investment. So be aware of these double taxation and also be clear about the tax treaties your home country has made with the foreign countries. If you are talking about India, you should be clear that where you have arrangements with, and so that by the time you are filing your tax in India, filing your tax return in India, you are able to better utilize those concepts, and also you can then actually save yourself from double taxation or paying these type of getting into such situations which may be unfavorable for your profit. So these kind of double taxation, tax treaties, everything should be clear to you. Then we have investment structures for Indian investors. So structure selection significantly impact the taxes, liability and operational efficiency. We have direct ownership, offers simplicity and direct control, but exposes you to personal liability and individual tax rates. You have local company formation in the property country, provides liability protection and corporate tax rates, but involves corporate compliance and potential dividend withholding taxes. We have offshore holding companies which offer tax treaty benefits, privacy and flexibility, but involves higher cost and potential anti avoidance scrutiny from tax authorities. So overall, these are different structures you can use. Recommendation would be that you look for structure choices depending on the investment size, risk tolerance and tax optimization objectives you have, and the larger investment typically justifies more complex structures. That is, you can go for complex structures if you have larger investments to make. Then we go to Indian regulatory framework, LRS. So here the liberalized remittance system, remittance scheme governs individual foreign investments. So the annual limit is USD 250,000 per individual per financial year for direct property acquisition abroad, requiring Form A2 declaration. For larger investments, consider family pooling, where multiple family members combine limits, though this may require multiple years for full funding. Then we have alternative routes including overseas direct investment for companies, and then compliance requirement include annual foreign asset disclosure and Schedule FA, global income taxation in India, and foreign tax credit claims. So proper compliance is non-negotiable, and the penalties for non-compliance are severe. So these are some important rules which you should be aware of before you venture out and invest. Then cross-border operational challenges. So operational challenges in global real estate investment are significant but manageable. Information asymmetry, limited access to local market data, and unfamiliarity with the neighborhood dynamics. Then we have property management oversight. It becomes complex due to distance, time zone differences and cultural gaps. The solution is professional property management firms with international experience and strong reporting systems. And then we have vendor selection. The challenges arise from limited knowledge of local service providers and difficulty assessing the quality and cost, and then we have to rely on the established property manager networks and thorough due diligence processes. And then we come to crisis management. From distance, requires local representative and emergency protocols. You need boots on the ground when issue actually arises. So local representative and emergency protocol are very important here. So looking back at the solutions again, for information asymmetry, engage local market experts and advisors. For property management oversight, professional property management firms with international experience. You can look out for them in India itself. And then vendor selection, go for established property managers network. And for crisis management, you should have somebody as a local representative, and emergency protocols should be there, that in case of crisis, how you will handle that. So basically, you should be prepared for all these operational challenges, and you should be very clear from in India itself that how you will be going about all these investments, very clear, because it's not just about return but also safeguarding your own investment in these properties. Then moving to cultural and business practice difference. So cultural intelligence is often underestimated but crucial for success. The negotiation style vary dramatically. So German directness versus Asian relationship building approaches require different strategies. Business practice differ significantly. UK leases feature upward only rent reviews, while US leases include tenant improvement allowances, and transaction process involves escrow, deposits and closing procedures which vary by markets. And then we have adaptation strategies, so which include developing cultural intelligence, engaging local advisors, investing in relationship focused markets. So these will be your adaptation strategies, and maintain the flexibility in operational procedures. So some of the things you can actually do about them will be you can read about these cultures more, so that you cultural intelligence can develop. Then you can have local advisor for telling you how to negotiate. You can do this online now also. And relationship investment in relationship focused market, how you have to make relationship in these markets, how you have to interact with people. So these are some important issues which are culturally significant and definitely can impact the kind of price and the stability you can achieve in a particular property investment. So all these are very important. You can also call them as business ethics, or how the business is actually done in these countries. And when you are going there or you are investing there, you should be aware of these relationships. And then flexibility in operating procedures also you should maintain. Then coming to global investment strategies. So let's discuss the investment strategies aligned with risk return profile. So you have lower risk strategies, core strategy, then core plus strategy, which is moderate risk, value add strategies. You have opportunistic strategy. So we have learnt about these strategies, but how to implement them here globally. So for example, core strategy which targets 7 to 10% return through high quality properties. It can be done through high quality properties, prime location. So you can go for high quality properties, prime location in outside countries. You can go for long lease terms, strong tenants. So when you are talking about core strategy implementation in global global portfolio, you should look at these properties. You are looking at these properties outside India. Then core plus strategy will include targeting of 9 to 12% return, and the quality properties with manageable issues. So some lease rollover and moderate capex requirements using 50 to 65% leverage. And then value add strategies will be target 12 to 18% return. Repositioning opportunities can be found here, and which also some opportunities which require significant renovation, and 65 to 75% leverage is something you might be looking for this. And opportunistic strategy will include development projects and distressed assets. But please note that if you are making your investment for the first time outside Indian geographical limits or any of your home country geographical limits and going outside, the prudence is that you start with core strategy, because there are so many things to understand for the first time about the foreign markets, the kind of rules they have, the legal rules, the kind of currency risk you have, and then on the top of that, the cultural difference which we have. So in such scenarios, it is always prudent that we start with core strategy, and then if you are more acquainted about that particular market, you can then move on and go on taking more risk with the core plus strategy, or even going for opportunistic strategy. But the idea is that if you are already having so many risks because of the kind of differences between your own home country market and foreign market, so on the top of that, if you actually go with some risky assets, that will not be prudent at the starting of any investment journey. So that is how you can actually start. Then you can also look at portfolio construction framework. So portfolio construction requires systematic thinking across dimensions. So geographic diversification should include gateway cities like London, NYC and Singapore for lower risk and lower yield, regional hubs like Manchester, Austin and Frankfurt for better yield, and we have emerging markets, 15 to 13% allocation for growth. And then we have property diversification, type diversification, that might include 25 to 35% office for longer leases, and institutional quality, 20 to 30% residential for stable demand and inflation hedging, and 15 to 25% industrial for e-commerce growth, and 5 to 15% for retail for higher yields despite structural challenges, and 10 to 20% for specialized sectors like data centers and healthcare. So all this can be the another form of diversification. And then risk allocation, you can typically for core or core plus, risk allocation can be 60 to 80% of the portfolio, and value add opportunities that will be around 20 to 40% of the portfolio. So this framework provides systematic diversification while maintaining the return targets. So that is how you can construct your portfolio in terms of geography, property type and risk allocation. So earlier when we were discussing all these strategies, we were looking at Indian scenarios, but this time when we are going outside, how we distribute properties geographically, property type diversification, risk allocation, you can have much more options to invest. So another big advantage is when you go outside, that apart from geographical diversification, the available property types may also increase. So that opportunity which you can, if you are looking for a specific type of property, for example data centers, and you have fewer options in India, then you might go outside and you may find more options. So these kind of property diversification options also increases in other parts of the world. Then we go to performance measurement. So how can we measure the performance in them? So that we have NOI growth, we have cash on cash return. All these we will be looking at when we are trying to measure performance. So for measuring global performance investments, you will require both local and home currency analysis. You will require income return metrics like NOI growth for property level performance, cash on cash return for equity yield measurement, and cap rates for relative value comparison. Then you may also look at total return. So total return analysis will require IRR in local currency for property level performance, IRR in your own country currency, for example in INR, for your actual return after currency effects, and equity multiples for absolute return measurements that will be there. And then risk metrics include DSR, DSCR for debt coverage ability, occupancy trends for leasing performance, and currency exposure for unhedged foreign currency risk, and then benchmarking against MSCI Global Property Index and country specified indexes. So this way you can have a proper performance measurement, whether in the for the income returns, for total returns, or for the risk matrix. So that is how you can measure the performance. Then going to risk measurement best practices. So risk management must enhance for global investment. Due diligence enhancement requires extended technical and legal due diligence, local market expertise, engagement, and environmental and regulatory compliance verification. Operational risk management involves professional property management selection. It will also involve regular reporting and monitoring systems. It will also include periodic site visits and inspection. So it's better that you actually hire somebody and they can do all this on your behalf. That can also be done. And then financial risk management, conservative leverage appropriate to market, interest rate hedging for floating rate debt, and staggered debt maturities, something you can see in financial risk management. And portfolio risk management would require diversification across geographies and property types. We have discussed that. Stress testing under adverse scenarios. We can also explore that if the worst, different worst cases, we can see the how the currency fluctuation, at the worst possible levels, and then accordingly calculate our, impact on our returns, or if there is, some property related setbacks, whether in the form of occupancy. So that can be also stress tested, and we can understand the different scenarios. And currency hedging strategies also, that we can basically test different currency hedging strategies and find the most suitable for our purpose. So we have seen that what kind of strategy we can use for currency hedging. There is a suggestion also made for this particular currency hedging strategy. And then we go to exit strategy planning. So exit strategy planning should begin at acquisition. You have hold period considerations, vary by strategy. Core investment typically hold 7 to 10 plus years with refinancing options. Then in hold period considerations, you can also have value add for 5 to 7 years aligned with business plan. And opportunistic also in hold period consideration can be 3 to 5 years for development repositioning. For exit method, it will include outright sale for complete disposition, partial sale to crystallize gains while retaining upside, refinance to extract equity without disposition portfolios. Of course, this will be a very rare case when we are. Exit timing factors include local market cycle position, capital exchange rate outlook, and tax optimization consideration. As much planning as successful execution. So all this has to be that how will you exit your investment. Then let's take one case. A Mumbai based family office allocated USD 3 years with the 70% to markets and 30% to emerging markets, using 40%, 35% core plus 20% opportunistic strategy. So they mixed, they used, and this their year one in million included a Singapore office building, core USD US multifamily fund, core plus, and UK logistics JV 5 million USD core plus, USD 2 million liquid. So this kind of strategy they, and the risk management included currency hedging for local partnership in each market, and professional property. Systematic approach demonstrates practical implementation of. Then what will be the key takeaways? The key takeaways would be that to have diversification benefits, global real estate provides and sector diversification beyond domestic, market selection which is there, which can be very critical, should be there. Legal framework, you should be very clear about the legal framework. Rules significantly impact the risk return profiles. So you should be clear about all these rules, and then you decide on which. Currency risk it becomes very important, because dominate investment return and must be actively managed. Is there, it will require expertise. So professional help in these scenarios is very prudent. Are there, and basically if you can form local partnerships, somebody in your own country, for example in India, some kind of working, so you should go for them. And then effect taxes, liability and operational efficiency. So global real estate requires patient capital, and it also, you should think it in that way. Strategies. So step 1 will be education and strategy. You should you should be aware what are the rules and regulation, what are the different performances in India. So you can first have a good reading understanding of this area. Then define investment objectives, and objectives of going outside. What are the constraints you have in that particular issue, and then determine the geographies and sector geography you will be investing, and what will be your focus area. Analyze the target market for opportunities where you will be investing, which type of regulations and tax implications, and identify potential you will be going with. So if you are having a local partner to or if you want to hire a local professional, that. And then step 3 will be structural planning. So determine address LRS limitations and compliance advisors in the structured planning. And the 4th one is your pilot investment, core investment in transparent market. So first always start with core, and then follow experience and relationship, learn operational management practices. Then question for reflection, which are very have thought about all the topics we have discussed in this particular topic. So you should also think about these questions. So income generation versus capital appreciation with your risk profile. So developed versus emerging market preferences. How will you local partnership strategy that can come, property, think about other things also. And what is your currency risk management strategy? So what will be your hedging strategy for currency? That also you should be very. Thank you so much.